Right now, as you're watching this video, one of the largest banks in the world has quietly crossed a line it never wanted to cross publicly. BMO Capital just put a $4,600 target on gold, not in a YouTube interview, not in a speculative blog post, inside a formal institutional forecast. That number matters, but not for the reason most people think, because the real warning is not in gold, it's in silver. Let me show you. When a conservative bank like BMO floats a number like $4,600 for gold, it is not making a prediction. It is admitting a breakdown in assumptions. Banks don't project extreme outcomes unless the baseline model stops working. They do it when the range of outcomes widens beyond control. This is not optimism. It's risk disclosure. Think about that for a moment. Gold does not move to $4,600 in a stable system. It moves there when currency confidence erodes, debt mathematics fail, and hedging demand overwhelms paper suppression. That already tells you something is wrong. But here's the part nobody realized. Every time gold enters that kind of regime, silver stops behaving like a precious metal. It starts behaving like a pressure gauge. And at $65, that gauge is already flashing red. Silver doesn't lead crises with headlines. It leads them with mechanics. Gold moves when fear is acknowledged. Silver moves when systems begin to fail quietly. That's why the $65 level matters more than the $4,600 headline. This already happened before. In every historical monetary rupture, gold told you something was wrong, silver told you how bad it was. In the 1970s, gold rose steadily as confidence faded. Silver went vertical when the system lost control. In 2008, gold climbed as insurance. Silver collapsed first, then exploded as liquidity snapped. Silver always reacts to stress earlier and more violently because silver sits at the intersection of money and industry. And that intersection is breaking. Here's the hidden connection BMO didn't spell out. A $4,600 gold scenario implies persistent inflation, currency debasement, and negative real rates far into the future. That environment does not coexist with cheap silver. It cannot, because silver is not just money. It is infrastructure. Solar grids, electric vehicles, defense systems, electronics, all of them consume silver continuously. And unlike gold, silver is destroyed when used. Once it's gone, it doesn't come back. This is why $65 is not a spike. It's a signal. It tells you that industrial demand is colliding with monetary demand at the same time. That collision never ends quietly. Here's where the warning becomes unavoidable. Gold at $4,600 suggests a system hedging against collapse. Silver at $65 suggests the system is already rationing materials. Those two signals together are just not bullish. They are diagnostic. They tell you the market is transitioning from pricing risk to managing scarcity. This is the shift most people miss. Gold protects wealth. Silver exposes constraints. When silver breaks out alongside gold, it means stress has moved from balance sheets into supply chains. That is a much more dangerous phase. Think about that for a moment. You can print currency, you can backstop debt, you cannot print silver atoms. This is why silver moves asymmetrically. Once demand exceeds supply, price does not negotiate, it reallocates. That is exactly what $65 represents. Now, look at timing. BMO's projection did not come out during a crisis. It came out while markets are still pretending stability exists. That tells you the internal model's already broke. Institutions don't wait for chaos to adjust forecasts. They adjust when early indicators no longer align. Silver was one of those indicators. Rising physical premiums, persistent deficits, exchange interventions that failed to cool demand. Those signals forced gold models to expand their upper bounds. Silver forced the issue. This already happened before. In the late 1970s, silver's behavior preceded gold's blow-off. In the early 2000s, silver signaled industrial strain before commodity inflation was admitted. Silver's doing it again, but this time, the system is more leveraged, more indebted, more dependent on electrification. That makes the signal louder. Here's the uncomfortable truth. A $4,600 gold target is not a bet on upside. It is an admission that monetary anchors are slipping. Silver at $65 is the proof that physical anchors are snapping. Those two together change everything. They tell you this is not a cycle, it is a regime shift. And regime shifts do not resolve with pullbacks and mean reversion. They resolve with repricing and reordering. This is why focusing on gold alone misses the danger. Gold is the symptom the system is willing to talk about. Silver is the symptom it hopes you ignore, because silver exposes the part of the crisis that cannot be solved with liquidity. Once silver becomes scarce, everything downstream feels it. Energy costs rise, manufacturing slows, defense procurement tightens. Those are not financial variables, they are physical constraints. This is why the $65 silver level matters more than any gold forecast. It tells you the system is already operating beyond its comfort zone. And when silver moves into that zone, history shows what follows, not immediately, but inevitably. This is the warning embedded inside BMO's headline. Gold at $4,600 is where fear ends up. Silver at $65 is where failure begins. And once that line is crossed, the system does not calmly step back. It adapts, violently. To understand why silver is the real warning inside BMO's gold call, you have to understand how stress actually travels through a system, not through headlines, through constraints. Here's the part nobody realized. Gold reacts to fear. Silver reacts to failure. That difference matters. Gold rises when confidence weakens. Silver explodes when functionality breaks. This already happened before. In the 1970s, gold climbed steadily as inflation became undeniable. Silver didn't move much at first. Then the system reached a point where controls stopped working. Energy costs surged. Industrial inputs tightened. Silver went vertical. That was not speculation. That was pressure release. The same mechanism is visible now. Gold moving toward a $4,600 scenario tells you institutions are hedging against monetary instability. Silver at $65 tells you industrial systems are already under strain. Those are two different stages of the same event. Think about that for a moment. You can hedge inflation with gold. You cannot hedge a missing input with paper. Silver is not optional in modern industry. It is embedded in systems that do not pause. Solar capacity cannot expand without it. EV production cannot scale without it. Defense electronics cannot function without it. When demand from those sectors collides with monetary demand, silver stops behaving like an investment. It behaves like a bottleneck. That is why silver's moves are always sharper. Here's the structural problem. Global silver supply has been flat for years. Most silver is mined as a byproduct. Higher prices do not immediately create more supply. At the same time, demand is accelerating now, not in the future. Now, that creates a timing mismatch that price must resolve. Gold does not face that constraint. Gold sits in vaults. Silver gets consumed. Once silver is used, it is gone. This is the part most people miss when they compare the two metals. Gold is a stock. Silver is a flow. Flows break systems faster than stocks ever do. This is why silver reacts earlier. Now look at market behavior. At $65, silver did not calm down. Interventions failed. Margin hikes triggered buying. That tells you something critical. When suppression creates demand instead of fear, the market has entered a new regime. That regime is defined by scarcity management. This already happened before. In energy markets, price caps didn't reduce demand. They increased hoarding. In food markets, controls didn't stabilize supply. They accelerated shortages. Silver is entering the same phase. Here's where BMO's gold forecast becomes revealing. Banks do not publish extreme targets casually. They expand ranges when uncertainty overwhelms models. Silver is one of the variables forcing that expansion. Rising silver prices indicate rising costs across the real economy. They signal inflation that cannot be papered over. That feeds directly into gold models. Gold is reacting to the effect. Silver is reacting to the cause. This is the inversion most people miss. You are not supposed to see silver move like this in a stable system. You only see it when something underneath is breaking. Now add psychology. When gold rises, people talk about hedges. When silver rises, industries talk about supply. That conversation is already happening quietly. Procurement teams are locking contracts. Manufacturers are front-running demand. Inventories are being secured earlier. Those behaviors never show up on charts, but they determine availability. Once that shift happens, silver no longer respects technical levels. It respects deadlines. This is why $65 is not a ceiling. It's a signal that deadlines are colliding. Energy targets, manufacturing schedules, defense procurement cycles, all of them require silver on fixed timelines. And timelines do not wait for pullbacks. This is the doom mechanism. As price rises, demand accelerates. As demand accelerates, supply tightens. As supply tightens, delivery risk increases. That loop feeds itself. Gold does not create that loop. Silver does. This is why silver always looks too volatile right before it becomes essential. Volatility is the symptom of rationing. Price is trying to decide who gets the metal. That is what $65 represents. Now, consider the historical echo. In 1980, silver's move exposed leverage and forced rule changes. Today, silver's move is exposing dependency. Dependency is harder to manage. You can crush leverage. You cannot crush need. This is why comparing today to 1980 underestimates the risk. Back then, silver was financial. Today, it is infrastructural. That changes how crises resolve. Instead of a blow-off and collapse, you get fragmentation. Paper prices diverge. Physical premiums expand. Access becomes uneven. This is already visible. Silver is no longer one market, it is splitting, and splits never heal quickly. Here's the key takeaway of part 2. BMO's $4,600 gold call is not bullish bravado, it is a stress response. Silver at $65 is the input forcing that response. Ignore silver, and the gold number looks extreme. Understand silver, and the gold number looks conservative. That is the warning. Gold is where the system admits fear. Silver is where the system admits constraint, and constraint always comes first. By the time gold reaches its destination, silver has already reshaped the terrain. That's why watching silver is not optional anymore. It's diagnostic, and the diagnosis is not comforting. Because when silver breaks out like this, it means the system is no longer debating risk. It is already managing failure. That is the stage we are entering now. To understand why this does not resolve quietly, you have to strip away emotion and look at arithmetic. Not forecasts, not opinions, math. Here's the part nobody realized. The silver market is not tight because of speculation. It is tight because the numbers no longer balance. And once numbers stop balancing, markets don't stabilize. They enforce. Think about that for a moment. Global silver mine supply sits a little above 800 million ounces per year. That number has barely moved in over a decade. At the same time, industrial demand alone is now consuming the majority of that supply. Solar installations require silver, whether prices rise or fall. Electric vehicles require silver, regardless of sentiment. Defense and electronics demand does not pause. This is not cyclical demand. It is structural. Now add monetary demand. When gold models expand toward a $4,600 scenario, it implies persistent negative real rates, currency debasement, and institutional hedging. Every one of those conditions pulls additional demand into silver. That is the collision point. Industrial demand does not step aside from monetary demand. They stack. This is why silver behaves the way it does. Here's the mathematical trap. Most silver is mined as a byproduct of copper, lead, and zinc. That means higher silver prices do not automatically produce more silver. Production responds to base metal economics, not silver scarcity. So even if silver prices double, supply barely moves. That is the definition of inelastic supply. Inelastic supply plus rising demand produces only one outcome: price escalation. This already happened before. In energy markets, underinvestment created years of artificial stability. When demand returned, prices did not creep higher. They jumped. Silver is following the same curve. Now look at inventories. Above-ground stocks have been drawn down to cover multi-year deficits. Those inventories were never meant to support permanent imbalance. Once they thin past a certain point, price becomes discontinuous. Not gradual, stepwise. That is exactly what you saw at $65. It wasn't a slow grind, it was a jump. That jump tells you inventories are no longer buffering demand. This is the critical signal. Markets only gap when buffers fail. Here's where gold re-enters the picture. Gold at $4,600 implies loss of confidence in monetary anchors. Silver at $65 implies loss of confidence in physical availability. Those two together signal a system under dual stress. Monetary stress can be managed with policy. Physical stress cannot. You can print currency. You cannot print silver. That asymmetry is why silver always leads the most disruptive phases of financial resets. Now look at behavior. At 65, silver did not see demand destruction. It saw acceleration. Physical premiums expanded, delivery lead times lengthened, long-term contracts increased. Those are not bullish indicators. They are rationing signals. They tell you buyers are no longer price sensitive. They are access sensitive. Once that shift happens, price loses its traditional meaning. It becomes a gatekeeper. This is where historical parallels matter. In 1980, silver exposed leverage and collapsed once rules changed. Today, silver is exposing dependency. Dependency does not collapse cleanly. It restructures supply chains. That means volatility does not resolve into a neat top. It persists. Here's the inevitability lever. Even if demand growth slowed tomorrow, existing deficits would still exist. Even if prices fell temporarily, contracts would not disappear. Even if sentiment cooled, infrastructure would still need metal. This is why pullbacks are shallow and violent rallies return quickly. The market is not trading enthusiasm. It is allocating scarcity. That is a fundamentally different regime. This is also why banks like BMO expand gold targets. They are not modeling upside. They are modeling tail risk. Silver is one of the inputs forcing those tail risks wider. As silver prices rise, they feed directly into inflation models, cost structures, and geopolitical stress assumptions. That cascades into gold forecasts. Silver is upstream of gold in the stress chain. This is the connection most people miss. Gold reacts to policy failure. Silver reacts to physical failure. Policy failure can be delayed. Physical failure cannot. That is why this is irreversible. Once physical systems adapt to scarcity, they do not return to abundance behavior. They lock supply, they stockpile, they secure access. Those actions remove metal from the open market permanently. That tightens conditions further. This is the feedback loop that defines late-stage shortages. It feeds on itself. This is why calling for normalization misunderstands the phase. Normalization requires elastic supply. Silver does not have it. This is why BMO's gold call should be read as confirmation, not speculation. When banks expand targets that far, it means their base assumptions have failed. Silver is one of the reasons. At 65 dollars, silver is no longer whispering. It is signaling loudly. It is telling you that the system is now operating beyond its comfort zone. And once a system crosses that line, it does not quietly step back. It adapts through repricing, restriction, and reallocation. Those processes are messy, they are volatile, and they are one-directional. This is the math behind the warning. Not hype, not fear, arithmetic. Silver's numbers no longer balance. And when numbers don't balance, markets don't negotiate. They correct, forcefully. That is the phase we are in now. And once silver enters this phase, history shows there is no clean exit, only adjustment. And adjustment always costs more than anyone expects. There is a moment in every cycle when institutions stop debating probabilities and start preparing for outcomes. Not publicly, internally. That moment is already past. Here's the part nobody wants to say out loud. BMO's $4,600 gold projection is not a forecast of upside. It is an admission that the old anchors no longer hold. Banks don't publish numbers like that because they expect smooth transitions. They publish them when tail risk becomes central. That's the confession. And silver at $65 is how you know the confession is real. Think about that for a moment. Gold is where institutions admit fear. Silver is where they admit constraint. Fear can be managed. Constraint cannot. Once physical limits enter the equation, the system stops arguing about valuation and starts managing access. That is the phase we are entering now. This already happened before. In the late stages of every monetary reset, gold was the headline. Silver was the mechanism. Gold reflected loss of confidence. Silver reflected loss of control. And loss of control is what forces change. Here's the final shift you need to understand. When silver was cheap, it was treated as a trade. When silver reached 65, it became a liability for manufacturers, a liability for governments, a liability for systems that assumed it would always be available. Once something becomes a liability, behavior changes fast. Contracts get longer, inventories get hoarded, exchanges lose relevance. This is why markets feel unstable right now. They are not unstable. They are reclassifying. Silver is moving from market commodity to strategic input. And strategic inputs are not priced freely. They are allocated. This is where the quiet control narrative completes. Publicly, officials will reassure. Privately, supply chains will harden. You will not see press releases announcing this shift. You will see symptoms. Delivery delays, rising premiums, private contracts bypassing exchanges. Those are not anomalies. They are adaptations. This is also why waiting for confirmation is the mistake. By the time confirmation arrives, access has already changed. Markets do not announce regime shifts in advance. They reveal them through behavior. Silver's behavior is already different. At 65, it stopped responding to suppression. It stopped respecting old ceilings. It stopped acting like a precious metal. It started acting like a bottleneck. That's the final warning embedded inside BMO's gold call. A world that prices gold at $4,600 is a world that has already accepted monetary failure. A world that prices silver at $65 has already accepted physical failure. Those two together tell you where this is heading. Not toward a neat peak, toward a reordering. This is the part history makes brutally clear. In every cycle where physical constraints collided with monetary stress, markets did not revert. They reorganized. Access became uneven. Prices became volatile. Confidence fragmented. And once that happens, old benchmarks lose meaning. Asking whether silver is overbought becomes irrelevant. Overbought relative to what? A supply model that no longer exists? This is why comparisons to past highs fail. The past assumed elasticity. The present does not have it. Silver is not expensive because people are excited. It is expensive because the system is crowded against a limit. Limits do not negotiate. They force decisions.